So we're here at IIREC, and we're a proud sponsor of the event. It's been a great event. It's now Saturday. We're here in Manhattan Beach. We played golf right behind us here on Thursday, and was listening to the panels and had an interesting thought that actually I've had internal conversations with fellow investors a lot with, but never really thought to turn this into a topic. But it's actually a really interesting portfolio optimization discussion, and it's surrounding cash flow. So in our space in multifamily, something that is very attractive is the cash flow. And you hear a lot of people say, I'm a cash flow investor, right? Maybe they invested in the stock market, didn't really find that to be fulfilling or in line with their investment strategy, and then they discovered the real estate's ability to deliver cash flow, and that's what they get all excited about, and they say, well, now I'm a proud cash flow investor. Everything I do is about cash flow. And so what I want to talk about is cash flow is really overrated. And I'm speaking solely from a portfolio perspective, not from a deal perspective. Any deal that has cash flow, that's amazing, and the more cash flow a deal has, the better. But from a portfolio perspective, there's actually downsides to cash flow. Cash flow often comes with a tax consequence, and also it creates reinvestment risk. If a deal's giving you cash, you have to now take that cash and reinvest it, right? If you have a deal that has an X IRR of, let's say, a 15% IRR, well, technically speaking, all the cash that you receive as distributions from that deal have to be reinvested at the internal rate of return of 15% in order for you to truly earn that 15 IRR. So essentially, deals with more cash flow overstate the IRR, because in reality, you're not going to reinvest every single dollar coming back to you at the IRR rate. Whereas if you do a development deal where there's no cash flow, and then finally, boom, there's a pop on a sale, that's more of a true IRR. So the reason why I say cash flow is overrated is because you only need so much cash flow. As you're building your portfolio and growing your passive income and your investment base, you only need enough passive income to comfortably support your lifestyle, if that's your goal. If your goal is to be a cash flow investor and to supplant your active income with passive income, then you don't need, if your expenses per year are $500,000 because you're living large and enjoying life, well, you only really need $500,000 of passive income. So if you're at that level of $500,000 passive income and you're covering your expenses, and let's account for a cushion as well, we don't want to live on a razor thin margin, then going to $1 million of cash flow really doesn't behoove you, because all you've done is created another $500,000 a year that you have to reinvest and potentially face a tax consequence. So now you have to do more tax planning. So instead, if you would have invested in other ways that was more optimized for total return and less about cash flow, you would actually potentially put yourself in a better position from a tax perspective, from a reinvestment perspective, and from a total return perspective, because often investments have a trade-off of cash flow versus total return. What I mean by total return is IRR, right? And it just makes sense. If an investor is willing to forego cash flow, such as in a development deal, they're going to not get cash flow for the first year, second year, maybe even third year, but then finally, if the deal is successful and the development sells or refinances, they're essentially making up for all that missed cash flow in a much higher return. So that's this idea of you need to build up, if your goal is passive income, it doesn't mean you need to take that to infinity. You need to build your base and have that solid base, and then moving forward from that base, you can take essentially more risk, or put another way, you can forego cash flow in the pursuit of higher returns. And as I mentioned, those higher returns come with the ancillary benefits of often better tax planning and less reinvestment risk. Thanks for watching.